In this video, we are going to discuss the two key terms in accounting. Again, building blocks for the double entry system. We're going to learn about debit and credit. Most of you must be familiar with these two terms, but possibly you've not been able to figure out what these two terms mean. So let me demystify these two words and how these two words are going to be interpreted and used in the language of accounting. So there are three short topics that we will go over. We're going to talk about the concept of claims of business over something, and then I'm going to introduce you to the two words debit and credit, and I'm going to clarify one misconception or a confusion about these two words. The claim now refers to legal right of business over the use of a resource. Okay. Now we need to understand this very clearly because I'm going to use this logic, this reasoning when we analyze various business transactions and when we learn how to record the transactions in the books of accounts. So please pay attention here. Business buys a right by paying for it. Okay. Now the first example, purchase of furniture. When business purchases furniture, when you purchase, let's say, you're purchasing a table, for example, or we draw a table. Okay. You purchase a table and you pay for it. So you pay money for it, and in return, you have the ownership. You have the ownership of this asset, anything that you want to buy. So what this ownership gives you really is a right. Is a right to place this piece of furniture in your premises. Okay? And when you place this furniture in your premises, nobody else should be able to, or nobody else should come to your premise and then remove this furniture from your premise or start using it for their own personal purposes. So, and if they do that, then you have the right, you could go to the police and you can file a complaint, and the police will come and then they will enforce your right. So, you have right which is enforceable, enforceable at law. So when the police comes, they will, go to the person who has, stolen your furniture, and they will ask them to bring it back, or they will bring it back, and then they will punish this person because he, stole from your premises. So when we talk about a claim, we are talking about ownership, a right over the use of a resource. And when we say right, we really mean that you have legally enforceable right on that resource. You could really enforce the legal machinery of a country, of a geography, to have the right to use that particular resource for which you have paid. Okay, so that is the understanding, that's the depth that we wanted to go into in order to understand and in order to interpret the term claims of business correctly. All right, let me take another example, salary paid. When you pay salary, what is the claim that business has purchased or acquired, right? So again, a business pays salary to its employees. So you pay salary. In return, what do you get? You do not get ownership of people. Here, you get a right, you get a claim on the services of the staff, services of the employees. You can't buy people, of course. Slave trade is not allowed anymore. So the claim that business has is over the services of the employee. Now, if you pay to an employee and the employee is not working for you, you can sue the employee. You can drag him to the court, and the court will help you enforce, and the person will have to either pay you for the damages, for the revenue that you lost, or will work for you for the duration for which salary was paid to this person. Okay, so now this is a different case. In case of furniture, you were in physical possession of the furniture, you had claim on the furniture. But when you pay salary to employees, you really have a claim on their time, on their services that you want to get from them. So understand that claims are not only on the tangible things, physical resources, but also on the services. You can have a claim, you can have a right to use the services of somebody because you bind them by a contract and you pay a remuneration to them. Okay, so another aspect of claims of business. Sold goods. When you sell goods, what is happening? Again, let me draw a business here, and there is another business. Let's say this is a business to business transaction. You are selling goods. So, goods are being sold to the customer. Customer is another business here. And in return, what is happening is you are either going to get cash or this is going to be a credit transaction. However, we are more interested in what is happening here. Sales. So when sale is happening, what are do you have a claim that you create now for the business? Is there a right that business is creating for itself? So when a sale is happening, two things are taking place. One is the business generates a claim, business generates a right. And second is business gives up a claim as well, gives up a claim. We are giving up the claim on the goods, correct? We are giving up the goods, we are delivering the goods to the customer, and we are expecting a payment in return. So, what are you expecting? You are expecting cash. Your claims on the cash, whose cash? Cash of customer. So the business, when it is selling goods to somebody, some customer, the business earns, business creates, generates a claim on the customer, on the customer's resources, customer's cash that you want to have. But since the goods which have been sold is the topic of discussion, you are giving up your claim on the goods because you are selling it off to the customer. So now I'm talking about claim not being generated, but claims being sort of relinquished. You are giving up the claim on that, and in return, you are creating claim on something else, an equivalent resource. And as per the money measurement principle of accounting, everything has to be expressed in money. Give up goods, equivalent amount of money has to come into business. So business gives up a claim, generates another claim. Loan raised. Okay, when loan is being raised, what is happening? So again, this is a business, this is a bank. Let's say bank and business. So when business is raising a loan from the bank, bank gives money and business now has a liability. The liability is called bank loan, right? What is happening in this is, in this transaction, is that bank has now claim on the business rather than business having a claim on a resource. Bank has claim on the business, so the business is relinquishing some claims towards the bank. But of course there are two sides to it. Business has increase in the claims in terms of the cash that the business receives. So bank deposits money in the bank account of the business. So businesses claims on this cash go up. However, banks claim on the business also goes up. In other words, businesses claims are going down because an external party has claims on the business. If you do not repay the loan, then the bank can sue the business, and then legal machinery can be put to move, and the bank would recover money from the business. So claims of the business are going down on the other hand. So there are always going to be two sides because it's a transaction, it's a give and take. So that's also double-edged system. equal give, equal take, because everything is expressed in terms of money. So we'll go there, we'll get there. These are all the building blocks of the double entry system, and I'm slowly introducing to the dynamics of how we think about all these things and the ecosystem in which these transactions are created. So let's move forward. Another couple of items. Rent paid. When you pay rent to the landlord, you are earning a right, you're creating a new right over the use of the property for which you are paying the rent, right? You pay the rent, so the claim on the cash that you pay to the landlord, that claim goes down, but in return, the claim that you have bought for that cash is the right over the use of the property for which you are paying. So that's how we think about claims in the business. Another example of this is capital raised. When shareholders invest money in the business, what really happens is the business creates a claim. You have a claim on the money of the shareholders. However, you give up the claim, the business gives up claim in favor of shareholders as well. Now, claim are being given up on what? Well, on the whole business, because when business gets money from the shareholders, you get claims on the cash. But if you do not repay this capital to the owners of the business, then these people, the business, owes to these people. So owners, I should have said liability. So there is a liability that the business has towards the owners, and that's what the business entity concept states as well. Owner is separate. Owner is treated as somebody who's lending his or her resources to the business, right? So when business raises capital, business is giving a right to the owner, that the owner can demand from the business a repayment at whatever point is stipulated, or whenever business comes to an end, and the owner can legally reinforce that right as well. All right, so now let me introduce you to the two terms, debit and credit. Now you very well understand what is meant by claims of a business, and how a claim can be created, or claims can go down as well. At this point in time, you are very well equipped to handle these two terms, debit and credit. The word debit is used to refer to a scenario, is used to refer to, indicate increase in the claims of the business. And you know what is claim of the business? Right of the business over a resource. The business typically buys this by paying for it now, or by paying for it in future. So whenever there is an increase in claim, rather than saying, hey, claims are increasing, we say, hey, debit in the claims. All right. So if the claim of business is going up, let us say on an item called furniture, we are going to say furniture account. And we've also learnt about the types of accounts. I'm going to put that to use as well shortly. But furniture account, the record of furniture. Account is simply a record. Now furniture account, furniture record is going to show a debit. We're going to write a debit against it to indicate that business has purchased furniture and paid for it. By purchasing the furniture, we have increased, the business has seen an increase in its claim on the furniture. That is what is meant by the word debit. The debit basically translate or condenses this English sentence into one word. When you say debit, I know it means that the claim of business has gone up. Alternatively, you could also think about decrease in someone else's claim on the business, but I'll address this shortly. Let's look at some examples here. So as I said, purchase of furniture, you would say furniture account debit, furniture account debit. Now, purchase of land. When you purchase land, the business's claim on that land goes up. Business has the legal right over the use of this resource, which is called land. How are you going to reflect this in the books of accounts? You will say the land, you are keeping a record for the land that you have, the business owns, and you're going to call this an account. So land account is going to show a debit. You're going to write debit against it, and you're going to say, well, the value of land is 100. The value of furniture was 10, for example. Okay. So the value of the claim is 100 in case of purchase of land. When business purchases land, business's rights over the land go up, and there is a value which is assigned to this claim, to this right as well, which is equal to the value of the land, or the value which is paid by the business to whosoever earlier owned this land. All right, next is rent paid. Rent paid, there is going to be a rent account. Of course, you will maintain, every month if you are paying rent, you will maintain a separate, let's say, notebook for it, and you keep writing how much rent was paid. When business pays rent, as we discussed earlier, now business does not own this property for which rent is being paid, right? By paying rent, you earn the right to use the property for the duration for which rent is paid. So if rent is being paid, let's say for the next 6 months, advance rent, we are paying it, we have earned the right, the business will earn the right to use this property for the 6 months. So whenever you pay rent, salaries, etc., you earn the right over the use of a resource. You do not own the resource. There are some resources you can own, but there are other resources which you can only hire. So therefore, when you pay the rent, you are going to say, my claim on the use of this building has gone up. Please understand that the claim is represented by this word called rent. The word rent represents the claim. All right. The word rent does not represent the cash which is being paid. That is separate. Businesses cash is going down because you are paying the cash to the landlord in this case. So for cash account, you would say your claim is going down. Since the topic of discussion is rent account, the rent represents the claim on the use of the property, and your claim is going up. So you are going to write a debit here for whatever is the amount of rent. Okay. Again, please understand that when you pay rent, there are two sides of this coin. You are paying the cash. We are not talking about cash here right now. On the other side of the coin, you have the right that you have bought. What is that right called? That right is called rent. The rent represents that right. This is very important to understand, and you'll get a hang of it as we discuss more such items. Salaries paid, again, you pay in cash. Your claim on cash goes down. However, what you have bought, the right that you have bought, is the right, the claim over the use of services of the employees, and the name for that is salaries. So, salaries account. In a record, in a notebook where you write all the transactions relating to salaries, you are going to write a debit. You're going to say, my claim on the services of my staff members has gone up, and I'm going to write a debit. And the value of this claim is 20 because that's the money I have paid to these people. Okay. Then you have paid to creditors. The first part on the slide was increase in the claim of business, and in all these scenarios we have discussed the increase in the claim of business. Now we're going to talk about the opposite of the same, which is decrease in someone else's claim on the business. That can also be shown as the debit, as a debit. So business's claim going up is equivalent to somebody else's claims on business going down as well. So let's look at these couple of examples. Creditors, as we know, are our vendors, are the suppliers to whom you had, from whom you had bought the goods, and you have to pay to them. You have not paid them, that's why they are called your creditors. So, creditors again are the vendors to whom payments need to be made. Okay. So you now make the payment. The transaction says paid to creditors. So when you pay to creditors, in the book where you are maintaining a record for it, creditors account, you are going to say debit. Debit by whatever amount you have paid to them. Since you have paid to them 15 rupees here, their claims on the businesses no longer exist because you have paid for those claims. The claims only were, valid if you did not pay them, and then they can go to the court of law and then enforce you to pay. But when you pay them, that claim automatically sort of reduces. So even the reduction in somebody else's claim on the business, when it goes down, you say debit. Because the opposite of it is true. When somebody else's claim go down, business's claims are going up naturally. It's a zero sum game in that sense. Okay, then you have paid bank loan. You are paying bank loan. Bank had claims on the business. If you do not pay back the loan, the bank can come and recover that money from you through legal means, but you are paying back the bank loan. So the bank loan account, which represents the bank's claim on the business, that goes down. Therefore, business's claims go up. So you're going to write a debit here by the amount of bank loan, whatever that amount is. So these two items represent decrease in the claims of somebody else on business, and the remaining transactions which we did earlier, discussed earlier, they represent the increase in the claims of business by way of business paying for these resources. Okay, so that was debit for you. We've understood that increase in claims of business by either business buying those resources, or increase in the claims of business because somebody else's claims on business is going down. Both of these are represented by the word debit. Let's go to the other word, which is credit. What is credit? Now, credit refers to decrease. It's opposite of debit. So I hope it will make sense because I hope you have understood the word debit now. Opposite of that is credit, and we'll take some examples now. So decrease in the claims of business is represented by credit. Let's look at these items one by one. Loans raised. When you raise the loan, the bank has claim on the business. Claim on the business. Now, anybody having claim on the business is equivalent to reduction in claims of business. Claims of business. Because if the business does not pay back the loan, the bank can use legal machinery to recover the money. So in this case, when a new loan is raised from the bank, a liability gets created. The name of the liability is bank loan, and you create a record for it and you start calling it bank loan account, and you are going to write credit against it opposite this, which will indicate that a new bank loan has been taken and the bank has a claim on our business, because if we don't pay back, the bank can recover the money from us through legal channels. Okay, then is sale of goods. What is happening here is when you sell the goods, you are giving up the claim on the goods because you will get money in exchange for it. But we are only looking at one side of the coin right now. So sale account refers to the goods that you had in the business that you had bought earlier. When you purchased the goods, you had created your claims on the goods. Now you are selling the goods, you are giving up your claims on the goods that you are selling. So you're going to write credit here. Whenever you sell, you're going to write credit. Now, the point where people get confused is, hey, sales is my income. Money is coming in. It should lead to some positive sign. It should be debit. Please understand the two sides of the coin, right? Sales, goods are going out. Sales, money is coming into the business. These two are different aspects of the same coin, of course. So sale represents the goods, and as far as goods are concerned, goods are going out of the business. The claims of business on the goods is going down. The claim of business is going up on the cash, the money that you receive in exchange for the sale. So, that is the difference. That is the accounting language. That's the code you have to understand. Every transaction is going to be split into two. What is the give and what is the take, right? What is the debit and what is the credit? That's the two sides. That's why we call it double entry system as well. So, sale account is going to show a credit. You can show the other side of the coin, which is cash account. The cash in the business, that is going to experience an increase because you receive money in exchange for the goods given up, right? So this is the this is the give, and this is the take. I mean, receive and what is going out of the business. Okay. Next up is purchase goods on credit. You are purchasing goods from the vendor, but you're not paying to the vendor. So when you purchase goods, you will pay for it, or assuming that you paid for it, the claims are going up here. However, in return, the other side of the coin now is that there is your vendor, you have to pay to him, right? And you have not paid to him. It is on credit. Credit means you have not paid to him. So the vendor now has increase in his claims as well. But when vendor has, increase in his claims on the business, that means the business's claims are going down. So this is with reference to vendor. This is with reference to our business. We are always thinking from the point of view of our company, our business. So the vendor has claims on our business. So we are going to write creditors account credit, creditors account credit, and we are indicating that this creditor has a claim on the business. In other words, business's claim are going down because somebody else has claims on the business. So the two rules or two interpretations of the credit are, to summarize, as follows: decrease in the claims of business, that is credit, or increase in someone else's claim on business also refers to decrease in business's claims on its resources, right? So that is the explanation of the two words, debit and credit. And now let me clarify one misconception or a confusion really about debit and credit. It's not necessarily misconception all the time. Okay, all of us have bank accounts. I hope we do. And when you deposit the money in the bank account or withdraw from bank or ATM or pay through digital channels, you get an SMS. The SMS has typically this text. So when you are withdrawing, it says, "Dear user, your account is debited by this amount on this May 5th and whatever details. It can change." But the key item is it is telling you that your account is debited and you are withdrawing. So you're saying, I'm withdrawing the money and it is saying debit. Alright. So when you withdraw the money, it says your account has been debited. What does it mean? Now, whenever a business prepares its records, its books of accounts, it writes in the books of accounts from its own perspective. Here, the business is bank. The bank writes in its books of accounts from its own perspective. When the customer, so when a customer gives money to the business, deposits to the business, the bank has the responsibility, bank has a responsibility to refund, to return this money when the customer demands it, and hence it is called demand deposit as well. This is simple, your saving account. What does your saving account mean? You have your money, you go to ATM, withdraw it. You go to bank and you say, give me all my money. They will have to give it if you go in the official working hours. Demand deposit. This is kind of a liability for a bank. This is a liability. Also a source, and we've discussed that all sources are typically a liability. So bank has a liability towards you when you deposit money in the bank. On the other hand, when you withdraw from your saving account, then bank is relieved. Bank says, all right, I do not owe this person anymore. I have paid back my liability to this person. Okay. Now, when you deposit money in the bank, liability gets created. So bank says, hey, my claims are going down because the account holder's claims on the bank go up. When account holder deposits money in the bank is responsible to maintain that money. Therefore, when you deposit money in the bank account, bank says a credit. When you withdraw money from the bank account, then bank is relieved and bank says, now we do not owe this person 10,000 rupees because he has withdrawn this money. That means this account holder's claims on the bank are going down. Alternatively, bank's claims are going up on its own resources. So they say a debit. They write a debit. Okay. So bank is maintaining records of in lakhs of account holders, many account holders, and whenever account holders withdraw the money, that means that the claim of account holder, it goes down negative. The alternative is true, which means the claim of the bank is going up. And when the claim of the bank is going up, the bank will show it by writing debit. Where does it write debit? Against your name, against the account holder's name. So it will say customers account is debit by whatever this 22363, this amount, it gives it a debit, right? So the bank is writing from its own point of view. You are thinking, hey, it says debit, which means negative, but you are saying debit is increase in the claims. How is that possible? So I'm clarifying that confusion. When you receive an SMS, the bank has written in its own books for its own reference, and it has sent you a copy of the email, right? So bank is telling itself that the customer's claims have gone down, so my claims have gone up. And when you read it, you think, hey, my claims are going up or my claims are going down. So the only adjustment you need to make is when you read that SMS, think from bank's point of view. If you are bank, you are writing debit because my bank's claims are going up because bank has paid back to its customer. So that's how you should interpret the debit and credit used by the bank. The opposite of this is when your salary is deposited in your bank account, it says the salary has been credited in your bank account. What does this mean? As I just explained, when salary is deposited into your bank account, this is your bank, this is you, and let's say this is your company, this is your employer. You work for a month, and then you also have a bank account. After working for a month, your employer deposits your salary. So salary is deposited on your behalf. So for bank, it does not matter where the money came from. Of course, it matters the taxation for the taxation purposes. But I'm saying for bank, the money is coming into your account. So wherever customers account was, this customer's account, it has gone up by whatever amount of salary that has been deposited. And when more money has been deposited, there is more liability that the bank has. When bank has more liability, bank's claims go down. You have more claims on the bank because you can ask bank for more money. My employer just deposited my salary. I can ask for more money from the bank. So in that case, bank's claims go down, and reduction in claims, reduction in claims of bank are shown by bank as a credit. They say customer's account is showing a credit of 100 because more money has been deposited. We have more liability towards this person. This person has more claims on our bank. So let's write a credit there. All right, so I hope you now understand the concepts, the terminology, which is debit and credit. These are the two crucial words which you're going to see or hear over the next videos a lot of time. We use these two words to write the transactions in the books of accounts. Understand that debit and credit are two sides of the same coin, and this is the basis of the double entry system that we are learning. We are into the building blocks. So debit and credit make an important component of the double entry system. Since I say these are two sides of the same coin, every debit has an equal credit. This is another saying, not a saying, but it's a scientific truth that we have based upon which the double entry system is run. Debit is also represented by a short form which is DR dot, and credit is represented by CR dot. You must have also seen this in the SMS that you receive from the bank as well. Now you would say credit has C and R, so you can use C and R, but debit does not have D and R. So why do you use R? I mean, it's just a convention. This is how it has been practiced for long, and we're just following that. So DR stands for debit, CR stands for credit. Going forward, we're going to be using these short forms for debit and credit. Again, remember, debit and credit are two sides of the same coin, and every debit is going to have an equal credit. I'll see you in the next video.